Something just happened inside the S&P 500 that most investors completely missed. And if you don't understand it, then there's a good chance your portfolio is more exposed than you realize. Here's the uncomfortable truth about index funds. The S&P 500 is not the diversified, spread across everything safety net most people think it is. Instead, it's market cap weighted. So the bigger a stock gets, the more of your money automatically flows into it. And right now, the 10 largest stocks account for nearly 40% of the entire index. And almost all of those 10 companies are betting on the same thing, you guessed it, artificial intelligence. That's not diversification, that's actually concentration. And that concentration is a risk when some of the air finally comes out of the AI bubble. So today, I want to show you what's actually getting squeezed out of the S&P 500, and more importantly, where the opportunity is on the other side of that trade. By the way, I'm Steve Reitmeister. I've been investing for over 40 years, almost half that time as editor-in-chief of Zacks.com. And now I'm a partner at WallStreetZen, where I help develop a quant rating system to allow investors to quickly and easily find the best stocks. Now, if you like breakdowns on timely market events like this, then please give this video a like. It helps me out a lot. Much appreciated. All right, first, let's talk about what is happening in the market right now. For a moment, think about the S&P 500 like a parking lot with a fixed number of spaces. When the big SUVs take up more room, then compact cars get pushed to the overflow lot down the street. Not because anything's wrong with them, just because there's no room left. That's exactly what's happening inside the S&P 500, and it just played out in real time. The quarterly rebalance, which took place on June the 22nd, added Marvel Technology and Flex to the S&P 500. These are two AI and tech infrastructure names, further bulking up the group's exposure inside the index. To make room for these stocks, we have two on the way out. That includes Campbell's, the famous soup company. And then we have Pool Corporation, which is about swimming pools, and they got pushed down to the small cap 600. This happened not because their businesses collapsed, not because they did anything wrong, but because those big AI SUVs need more room. And this isn't a one-time thing. It's been happening for years, accelerating with every rebalance cycle because AI and tech infrastructure names keep getting bigger. Consumer names, industrials, energy companies, healthcare, they keep getting a little smaller in a smaller slice of the key market index. That's great on the way up, but to be on those momentum names, what could be very painful on the way down. By the way, if you like learning about market events like this, then one of the smart steps you can take right now is to sign up for my next live training session. The focus is my timely market insights plus top stock picks. I invite you to join my next one this coming Monday at 7 p.m. Eastern Time. Now, it's totally free, but you do need to sign up. So do that at wallstreetzen.com/live. Now, here's why all this matters beyond just the basic mechanics. When stocks get a smaller and smaller weighting in the key indices like the S&P 500, then there is less money bidding up shares, which often leads to these stocks trading at a discount. Again, this has nothing to do with the fundamental outlook for the companies. Simply, less index dollars are allocated to these shares, and therefore their prices are not as pumped up as they could be. And right now, that leads us to a significant discount. That's because small and mid-cap stocks are now trading at one of the widest discounts to large caps we've seen since the dot-com era. And that spells opportunity if you are looking in the right places. My view is to keep riding the bull market. That's because the U.S. economy is more resilient than people give it credit for, and there's not much reason right now to call for a recession and bear market. Now, the concentration of this index is at a historic extreme, and historically, extremes revert, not always with a crash, but with a rotation, meaning that money will flow to where the value is. And here's the thing, the rotation has already started. As of the week I'm recording, the equal-weighted version of the S&P 500 just outperformed the standard cap-weighted version by the widest margin in 6 years. Mid-caps and small caps are leading year-to-date performance, and the once beloved mega-caps and Mag 7 have been clear underperformers so far this year. It appears that investors have learned some valuable lessons from the dot-com bubble. Not everyone on the AI train can win, and valuations at some point do actually matter. And at some point, money starts flowing towards stocks that are actually trading at reasonable prices, and they are likely the ones to outperform as we move forward. Now, I'll be straight with you. I still like some of the AI and tech names. My three favorite are Micron, SanDisk, and Flex. The difference is that each still scores highly for value. That is why they are still members of my Zen Investor newsletter portfolio, which features my top 20 stocks for the long haul. But the point isn't to abandon the AI trade entirely. You can still play it wisely and profitably, as I just showed you. The greater issue is for you to understand that this area is too crowded and concentrated, and that it is wise to diversify your portfolio into other areas showing ample growth and value. And that's where our Zen Ratings quant model becomes the most beneficial. Not for finding the stock everyone's already talking about that are already bid up way too high, but for finding the hidden gem companies sporting impressive growth prospects and reasonable valuations. The kind the passive index flows are kind of skipping right now, but also the kind that will soar once more investors wake up to their uniquely attractive fundamental profiles. Now, I want to share some stocks that illustrate these concepts I'm putting forward in the video today. But before I do, let me remind you that I'm not your financial advisor. The stocks and data here are real, but any investment decisions are yours and yours alone. Always do your own due diligence before investing in any stocks. Now let's turn our attention to our first hidden gem stock in Star Bulk Carriers with a symbol of SBLK. Now, this is one of the largest dry bulk shipping companies in the world. They move grain, coal, and iron ore across the global trade routes. It's the kind of company that keeps the global economy running, but rarely shows up in any of the financial news segments. Star Bulk is a hidden gem because they just reported Q1 results that crushed expectations by 25%. Why did that happen? Because daily charter rates for the industry are soaring. This is from years of underbuilding the worldwide cargo fleet. This creates more earnings power for Star Bulk and its peers. This likely explains why the company just raised their dividend by 35%, meaning they expect the good times to continue to last into the future. And yes, the Zen Ratings quant model reviewing 115 factors for every stock is quite favorable on this company as well. By the way, I'm just doing a rapid fire review here today, but for way more information on this stock or any other, just enter the ticker in the search bar on WallStreetZen.com. Back to the Zen Ratings. Star Bulk earns an elite A grade, which equals a strong buy recommendation. Note that it's currently the number 5 ranked stock overall out of more than 4,600 analyzed. Now, as we look at the component grades, we see widespread strength with top marks for financials, growth, momentum, sentiment, and value. That's a well-rounded, solid business across nearly every dimension we measure. All right, true. Safety is only C-rated, but even there, we are in the top 32% of all stocks we review. Now, however, it is fair to say it is a more cyclical industry, which makes the stock a bit more volatile. But overall, we have an under-the-radar company enjoying serious earnings momentum and a well-rounded fundamental profile. The kind of stock that quietly outperforms in the background as AI makes a lot of noise. Before the next stock, if you're enjoying the insights from this video, then now would be a good time to subscribe and hit the notification bell. That's the best way to ensure you see the next videos I release. Our next hidden gem sitting outside the AI spotlight is HF Sinclair with the symbol of Dino. If you know Sinclair at all, then you are aware of their classic logo that includes a dinosaur, which is what begets the amusing ticker of Dino, right? But I digress. This one takes us pretty far away from the path from AI and other technology stocks. That's because HF Sinclair is one of the largest independent petroleum refiners in the United States. It doesn't benefit from AI infrastructure spending. It doesn't care what NVIDIA's next chip does. It refines oil and does it very, very profitably. Sinclair's Q1 results were a nice turnaround story with ample profits after an unsavory loss in the year before. That's because refining margins are running strong heading into peak summer driving season, and the company is already talking about expanding its Sinclair-branded retail footprint. This is a refiner converting recent strength into earnings momentum, all the while most investors still haven't taken notice. Okay. Once again, the Zen Ratings shines a light on a company with a truly stellar fundamental profile. Note that not only is Sinclair A-rated, which is reserved for the top 5% of all stocks we analyze, it is actually the number 2 ranked overall. Not top 2%, number 2, period. As you would expect, it scores highly with the component grades in the top 10% across value, growth, sentiment, financials, and our proprietary AI timeliness signal. A quick word about that last one. Our AI indicator is not about how much the company is involved with AI. Rather, it is our use of AI to spot stocks that look primed to outperform. In that respect, Sinclair is in the top 8% of that attractive category. When the rotation towards value continues, this is exactly the kind of stock that should benefit, especially as profit margins likely expand given the shortage of new refineries coming online in the United States. Oh, yeah. A nice bonus is getting a nearly 3% dividend yield on top of that likely share price appreciation. Let's finish strong with Bioventus with a symbol of BVS. You've probably never heard of this company. It makes medical products that support bone and tissue healing. Now, it's fair to say that pretty much nobody is making YouTube videos about medical device companies right now, and that's kind of the point, which is a great under-the-radar recommendation. Bioventus just posted a Q1 earnings beat that blew away Wall Street expectations. Revenue grew, cash flow turned positive, and management raised guidance for the rest of the year. This is a small company quietly compounding results when most investors are asleep at the wheel. Yet, the smart money is taking notice. This explains why some Wall Street analysts are pounding the table for nearly 70% upside to fair value in the year ahead. And yes, the Zen Ratings has circled this stock as well. Now Sinclair, as we talked about, is the number 2 ranked stock overall, and Bioventus is number 1 overall. They do not have a single area of weakness according to the component grades. All in the top 33% of stocks or higher. Now here we have standout scores for financial strength and safety, both in the top 7% of all stocks. Then we have a top 3% showing for value, top 1% for growth, and top 0.2% of all stocks for sentiment, which is our smart money indicator. This is truly a special fundamental profile that has historically pointed to share price outperformance in the months ahead. By the way, if you want to learn how to find more under-the-radar picks like these, then I invite you to join me this coming Monday at 7 p.m. Eastern Time for my next live training session. That is when I give timely insights on market direction and my trading strategy. This is also where I share my trade of the week based on our proven Zen Ratings quant model and my greater than 40 years of investing experience. Now, these sessions are free, but you do need to register to reserve a spot. So do that now at wallstreetzen.com/live, or use the QR code on your screen, or use the link in the description. Use whichever suits you, but whatever it takes, I look forward to seeing you this coming Monday. So let's bring this all together with 3 actionable steps you can take right now to position yourself intelligently in this market environment. Action number 1, check what you own. If your portfolio is heavily weighted towards a standard S&P 500 index fund, then go ahead and run the numbers on your actual exposure. You may be more concentrated in AI mega caps than you realize. That's not necessarily wrong, but it should be a conscious choice and not done by accident. Number 2, look at the squeezed out names. Remember, the stocks being squeezed out of passive flows aren't necessarily bad businesses. In many cases, they're solid companies at better valuations, and the data supports them. Starbulk, HF Sinclair, and Bioventus are 3 examples of exactly that. Strong Zen Ratings, non-AI sectors overlooked by the market right now. Action step number 3, position ahead of the rotation. Now remember, this is a slow-moving shift, not a trade at time before this weekend. But being positioned ahead of the rotation matters. The valuation gap between mega caps and small and mid caps is at a historic extreme. Now, history says the gap always closes. The investors who already understand that, are on the right side of this trade, are the ones who will benefit the most. The S&P 500 is more crowded and concentrated in AI and tech than most people realize. Now you know why, and now you know what you can do about it. Now, I want to hear from you. What do you think about my take on the market and the shift to smaller value stocks? And which of the 3 stocks I recommended do you like the most? Please share your thoughts in the comments section below. And if you like this video, then be sure to check out my view on 2 very different paths the market could take in the second half of 2026. It's good to be prepared for whichever road the market eventually takes. Please watch that now.